Peter, on this Monday morning, as we await and see what's going to happen in Washington, what are you telling your clients?
Hi, Andrew. Becky, how are you? Well, not much different than the advice we discussed on Monday last week, which is the market's very volatile. It will continue to be until there's some sense of stability both in the healthcare picture and in the financing markets. If you're invested without leverage, probably hold your position. It's obviously not a good time to sell equities, and it's not a particularly good time to sell credit. And that's most of the advice that we've been given. It's most of what we've heard. There is an opportunity in this market for humans to outperform, for active management to outperform, and we see that too.
And in terms of dipping your toes in the water, are you suggesting people do? Are you looking at this and saying that there's still another leg down?
Well, you
leg up?
Probably recall,
what are you expecting?
Yeah, you recall my comments again last week where I said this is a market that can be bought. If you have cash, this is a time to think about how to buy this market as it heads down. Even in its most volatile forms, I think there is a tremendous amount of history that suggests that markets recover over time. This will be no different. We have a very unusual global demand interruption caused by governments protecting public health. That will not last forever. And when it goes away, the market's going to go up.
Well, that may be, but here's one of the other pieces of this, and Ray Dalio spoke to it last week. If, in fact, we spend something on the order of, well, call it $3 or $4 trillion based on the numbers that Citi was suggesting we need to spend, by default, we're going to have, an issue with treasuries. If the value of treasuries falls, the value of assets fall. Is that right or wrong?
Yeah, I mean, look, I having gone through 2008, I think you have to look a little bit deeper than just spending $3 or $4 trillion. In the $3 or $4 trillion, there are a lot of loans. Some of those loans may be forgiven. A lot of those loans are paid back. And so the U.S. Treasury is not going to have to go out and raise $4 trillion of money tomorrow. Some of that money is a loan to allowing the Fed to actually go out and buy bonds, or at least accept collateral for bonds. So number one, we're not going to go out and issue $4 trillion of treasuries tomorrow. Number two, an increased treasury yield over time, will reduce asset prices. And look, I have said for the better part of 2 years, inflation is too low. And the markets are priced for very low inflation and benign environments. And this may be one of the things that causes a renewed growth in the interest rate. Now, and I want to say inflation because, look, I lived through 1973 and 4, and inflation, in the early 80s, and inflation was 7%, and bonds were 13%. I don't think we're going to see that. But interest rates on 10 years could go up, and that will affect asset prices, real estate prices, cap rates on real estate. Those things will happen. But that doesn't mean that the values of the assets as we currently see them in the market won't go up from here, which they will.
Peter, I saw Neil Kashkari it's Joe Kernan. Yeah, you didn't say hi to me, Peter. It's okay. It's all right.
Joe, I'm sorry.
I
didn't, of course, see you.
All right.
I didn't, of course, see you. I didn't know you were there. I didn't hear your mellifluous voice.
Yeah, I'm not sensitive. No, but the point about treasuries is a good one, and it can change at any time, obviously. But I did watch Kashkari last night on Scott Pelley asking him, and I had to laugh because he said, nobody is willing to buy our bonds now, and basically saying that they're worried about buying our paper. And Kashkari said, well, the 10-year's at 0.8%. So, I mean, it was like, I don't think
somebody
why people go on. Fine, you get a much wider audience on 60 Minutes, but you're going to get questions and comments like that from the people on that show. But there is money still moving into our treasuries. I mean, they're not necessarily moving in, but it's not like, we've seen a spike of 3 or 4 percentage points on our debt. It would be bad if we did, obviously. But so far.
Yeah, I don't. Right, Joe. I think you're right. I don't think that's going to happen. You have to think about the 10-year treasury markets around the world. as a global marketplace for safe assets. Now, the German Bund is minus 39 basis points. The Swiss securities are, I think, minus 47 basis points. So you can buy Switzerland or Germany at minus 47 or minus 36, or you can buy the U.S. 10-year at 80 basis points, or you can hold cash. By the way, in the last week, we saw a lot of people holding cash, and that actually caused gold to go down. It caused oil to drop through the floor.
Right.
And so, fear in the markets has definitely caused people to move to cash. That will not remain, and the U.S. Treasury will find an attractive rate. It won't be 4%.